Guys, I don't know if I've ever been more excited to tell you about a sponsor. It's called Children's Business Fair. And let me ask you a question. Is the classroom the best way to teach your kids about money and business? Well, of course it's not. And real learning comes from doing. Welcome to Children's Business Fair. It's a one-day event where young people can launch and showcase a business. You'll be amazed by what children can accomplish, and it's really a great way to bring your neighborhood to life. Launching a Children's Business Fair is super easy, and it's free. And guess what? They'll even throw in $500 of prize money. Just go find out more at podcast.childrensbusinessfair.org to get a children's business fair in your area today. Down to the City is about all things local. It really covers unique local businesses and business owners in the city, along with shedding light on the alternative music scene. And they have a YouTube channel, they also have a podcast, and they feature a video series where they showcase small businesses, and they check them out for themselves. One of the videos I was actually just watching is where they go into a tattoo parlor and they're interviewing the owner while getting tattooed. So really fun, entertaining, and a great way to get to know the local business scene. So make sure you check them out. It's dttwentertainment.com, or the YouTube channel is called DTTW Entertainment. I'll make sure to link it in the show notes. Well, welcome back to another episode of the Financially Free Journey podcast, and I'm your host, Courtney Dyer. And I hope all of you guys had a fantastic Mother's Day weekend and that you were able to spend it with your loved ones. And hopefully, if you're a mom, you got some pretty good relaxation or gifts, whatever floats your boat. But I definitely had a great holiday, and I was super surprised when my babies and my husband woke me up with breakfast in bed. That's never happened before, so I was not expecting that. And the gift that keeps on giving is that my baby, I have a 8-month-old, and she actually slept throughout the entire night. She's been waking up like 4 times a night. She decided to give me a present. So I thought, that's great. It was a great weekend, and I hope you guys had a fantastic weekend as well. Okay, so update. The Financially Free Journey website, I mentioned it a couple of episodes ago, but it's almost completely done being revamped, and it's going to be launching soon, probably by the next episode, either Friday or Tuesday. So I will make sure to let you guys know. But I'm so excited because a lot of you guys have asked, where are the show notes? Where can I go and read the transcribed episodes or click on hyperlinks of resources that you've talked about? So when the website's done, every episode is going to have its own landing page, like a blog post essentially, and you'll be able to see the recorded video of all of the episodes of the guests and myself, any resources that I reference, any promotions that guests offer or sponsors of our episodes. So it's going to be great, and there's going to be other resources available on the website as well. So I will make sure to let you guys know when it's out. Okay, but now let's dive into this topic because this is a hot topic, and I have probably received, I'm not kidding you, no less than 100 requests to talk about this. And so I thought, well, I gotta work this in. I gotta do an episode on this. So on your journey to financial freedom, you are obviously looking to replace your earned income, which is where you exchange your time for your money, right? But you're trying to exchange it to passive income, where your investments are throwing off enough cash flow and income to completely replace your earned income. And then you can be, at that point, work optional, and you're technically financially free. And as you research and you come up with your plan to achieve financial freedom, you have most likely come across real estate and building an investment portfolio of properties, and that these properties can have passive income, and that passive income can end up being a tremendous amount depending on the type of real estate portfolio that you build. So let's talk about how you can build a multi-million-dollar real estate portfolio using one simple method. Are you ready for that simple method? It's called BRRRR. Not like you're cold, not like it's chilly outside, but it's BRRRR. And you may be wondering, yes, you guessed it, it is an acronym, and it stands for buy, rehab, rent, refinance, and repeat. So let's go through this step by step, and let's break it down in a really simple way. So my goal is when you walk away from this episode, when you're done listening to it, that you actually have some actionable knowledge that you can be kind of dangerous with. You can say, you know what, I know where I'm going to go, and I know how I'm going to do this if this is something that interests you. So, BRRRR, as I said, stands for buy, rehab, rent, refinance, and repeat. And it is a really great strategy to buy rental properties with less money. One of the toughest parts about the investing in real estate market is the money that you need down for the down payments. And this is typically what holds most people back from being able to really pull the trigger, because you typically do need at least 20 to 25% down on an investment property that you're not going to be living in as owner occupied. Now, with the BRRRR strategy, you can buy a property with 20% down or with less using what we like to call hard money or private money, and then you refinance the property, getting most of that money, if not all of your money, back. This technique can allow you to buy a rental, take the money you used to buy it out of the property, and then you buy another property with that money. You're kind of recycling your own money to continue to build your assets. Now, when you compare conventional ways to buy rental properties and using the BRRRR method, you may have less cash flow after refinancing a property with this method, but you have more cash to buy more properties. And you can use the BRRRR strategy with residential or commercial properties as well, which is great to know because it does work for both. Now, let's just talk about what is the BRRRR strategy method. What is it exactly? As I mentioned, the basic idea of BRRRR is that you buy a property with cash or a loan, you make improvements, and then you refinance the property after you increase the value. So let's first talk about buy. You got to get a great deal on a rental property that you can add value to through making repairs. Now, when you go to rehab it, once you buy the property, you need to fix it up so you can easily rent it out. And when you're renting, once the property is fixed up, then you'll be able to rent it out and you'll start making that money, right, through the cash flow and the rent. Now, when you go to refinance, once you rent the property, it is much easier to refinance it than if you tried to refinance a house that was vacant and it's an investment property. But by refinancing it, you can then take most or all of your money back out of the investment of that property. And then you just simply go and repeat. So once you get that money back out, you can then find another great deal to buy, and then you repeat the process. So that whole rinse and repeat theory. So let's talk about how much money do you normally need. Let's get down to the nitty gritty here. When you buy a rental property, most banks will require at least 20% down. Plus, you will need to make the rehab to the property. So let's just say on a $100,000 purchase, you might need to spend 30 grand to buy the property, but most people have trouble coming up with that $30,000. So for one property, let alone multiple properties, that's going to add up to be a ton of cash. If you are buying more expensive properties, the costs increase relative to the purchase price. So just keep that in mind. It's typically a percentage of the total price for the amount of money that you're going to need to come up with. And then it gets really tough for people to afford rentals. The first step to use the BRRRR method is to find a property that is priced well below market value. This is really important. When you refinance an investment property, the bank will usually only refinance about 75% of the value, just for risk mitigation. If you buy a property at full retail value and then you try to go and refinance it, well, there's not going to be much money for you to get back out. And if you get a great deal, then you could get most, if not all, or even more money back than you spent to buy and fix up the property. So the key here is finding the right properties that are well below market value. So let me just give you an example, because I love examples. Let's say you buy a house for $200,000 and it needs about $20,000 in repairs. The house will be worth, let's say, $320,000 once the repairs are made. This is what Zillow's telling you. When you refinance the house, you can then get a loan for $240,000. Now, that new loan will pay off the first loan that you got when you bought the house, plus all the repairs that you did, and now you have $20,000 in cash out in this hypothetical example. Then you can take that money for a down payment in addition to the money that you put in for your down payment and all the repairs. So when you get a loan on the property, there will be closing costs. That's something to consider as well. And that's going to consist of things like appraisals and origination fees, lender fees, title fees, closing fees. It goes on and on. You need to make sure that you do some research on how much it's actually going to cost you to do the cash out refinance mortgage on the property before you think it's going to be all profit and that you're going to roll it all into your next property. So make sure that you go and you do, there's tons of BRRRR calculators online that can really help you run run these figures to make sure that you're making a really smart financial decision when you're looking at buying a property and then doing a cash out refi on the property and then taking that money and rolling it over to your next property. So now let's just talk about the BRRRR financing options, because this is where a lot of people get hung up and then they're not able to ever really pull the trigger. So the financing options can go like this. This can be one of the trickiest parts of the process. So you really need to do the work and talk to lenders prior to making an offer. So make sure that you have a mortgage lender readily available to consistently do your financing through. And after years and years in the finance industry myself and working directly with mortgage lenders, I would say one of the pro tips here is getting a really good mortgage officer that understands BRRRR, and that's going to be critical. And what you can do is you can work with this person and you can do underwriting and work through all the kinks on your first property, send them all your financials, because they're going to want everything up to, your firstborn. They're going to want 2 years of tax returns, your W-2s, your pay stubs, any profit and loss, any K-1s, everything you can think of, every, asset statement that you have, a personal financial statement. They're going to need tons of information, and you don't want to do that repeatedly over and over with a different person and having to re-explain yourself. So if you've got a really good mortgage officer, you can work through all your financials once, get all the kinks worked out and on that first property. Then they're really going to understand your finances, your credit and your income and all that important details that you went through that typically holds up your ability to put in an offer on a good property. You have to be ready to put in a good offer immediately when you're trying to get these properties under market value. And you can't put in an offer until you're sure that you have financing and that it's going to go through. You always hear this like, oh, the financing fell through. You've probably heard that when people are either buying properties or they're trying to sell properties. And that's because they prematurely put in an offer not knowing that their financing had already been worked through. And the underwriting process can be really tedious, and they can ask for tons of details. And that's why you want to work through all of that up front prior to identifying a property and really making sure that your income and your financials are going to be sufficient before you put in an offer. Because if you put in an offer and your financing falls through, well, you're going to end up losing what's called your earnest money. So when you make an offer on a property, you have to put down earnest money, and that's essentially a deposit for the person that's selling the property saying, hey, we are serious about this offer, and if we don't come through with our financing, you get to keep this money that I just gave you, and that's not good. So when you're looking at buying a property, there is a number of ways that you can look at getting into the financing. And this is really depending on what fits your finances best. Because again, not everybody has the same finances. So not everybody is going to be looking at, conventional loans or, what have you. So, but let's first talk about a conventional bank loan, because that's going to be the most typical run-of-the-mill loan that you're going to look at getting. You're going to need to put about 20 to 25% down. I mentioned this earlier a couple times now. But the interest rate should be comparable to that of a primary residence. And what that means is if you buy a house that you're living in for you and your family, this is called an owner-occupant loan or your primary residence. And the house cannot be in too bad of condition or the bank is not going to loan on the property, because when you go to get a loan from the bank, they're going to want to do what's called an inspection and an appraisal. So the appraisal is great for you because it's going to support you giving that lower than market value offer. But the inspection has to at least meet what the inspector says. Otherwise, you're going to be in this situation where the bank's saying, you know what, we're not willing to loan on that property because there's too many issues. The inspection also does protect you as the buyer to make sure you don't buy a property and you get in there and the whole house has to be rewired, for the electrical and all kinds of crazy things that you've probably seen on HGTV, right? So this is what protects you against that. As you all know by now, I am super passionate about education in our country, as well as your ability to increase your earning potential, which is why I'm so excited to tell you about this episode's sponsor. It's called Teachers of Tomorrow. So listen to this. The nation's leading alternative teacher certification provider, the most comprehensive provider of of teacher services in the United States. Their mission is simple. It's to develop confident educators who believe in the potential of every student and has helped more than 70,000 teachers reach the classroom. They have created a new way to become a teacher, and for the first time ever, you can become a certified teacher 100% online. So this means, number one, you don't have to go back to college, no student loans, you're not putting your life on hold because you have to work full time while you're trying to study. I mean, that's really hard to balance. The best part is this, guys. You can start teaching and earning a full-time salary in months, not years. Their state-approved program is designed with one goal in mind, which is to help you achieve your dream of teaching quickly, affordably, and simply. Teachers of Tomorrow has partnered with the podcast and is offering you a free application and a discounted enrollment fee of $295, which is $100 instant savings. This is the only fee that you pay, by the way, until you're hired full-time, earning full pay and benefits. So to claim this offer, just simply click the link in the show notes and episode description. Okay, so let's talk about local bank loans, because when you go to research financing options for BRRRR, what comes up a lot is the difference between national banks and local banks. And the theory out there is that local banks can be much more flexible when it comes to lending on rentals, that they're usually able to have, about the same amount of down payment, but they are more flexible than conventional loans when it comes to the underwriting, that they may overlook major repairs. I want to just, again, with my experience working for a large national bank and also working for a local regional bank, in the past, I have seen that really the lending requirements are about the same. So if you come across this, I just want you to realize that is a myth, okay? So it doesn't necessarily matter what bank you go to. If you do decide to go to a local bank, something that is going to help you is being able to work directly with a person, a live human, versus going through an automated system. And this is the same for buying any house, right? You go to a large national B of A, Wells Fargo, Chase, they have a built-in automated system that's going to run through all your information, and they're going to spit out an approve or decline right off the bat, right? Or they're going to say, even if it's a decline, they're going to come back and say, okay, we want to see A, B, and C from you for you to be able to fulfill these stipulations. When you're working with a local bank, it is a person from the very get-go all the way to the end that is going through and underwriting your information. They're reviewing your income. They're looking at your cash flow, they're looking at your debt. And so that is something that if you want to be able to work directly with a person at a local bank, which is something that I would suggest in this situation if you're trying to build a large real estate portfolio, if you have a direct person that you can have contact with, it can really help you work through these kinks, because then you can explain if there was a hiccup on your credit history, for example, you can explain that to a person versus an automated system that's built in. So again, that's up to you to do your research, but that's my personal experience working in the industry and also working for both types of institutions. That is a major difference that I have seen. Now, another option is what's called hard money lenders, and this is kind of an ambiguous term that you hear a lot. Hard money lenders specialize in loaning to house flippers specifically. But the loans can work for rentals as well. So you don't have to just flip the house and sell it like flip or flop. You can rent it out like we've been talking about with BRRRR. Now, the costs with hard money lenders are typically much, much higher. I mean, like double on the interest rates and than anything that a bank would offer you. But the nice thing about hard money lenders is that they will finance the repairs in some of the cases as well. So you're not having to come up with that cash. So again, as I mentioned previously, depending on your finances and your preferences. I'm not going to tell you one way or the other because I don't know your income or your credit or your situation, but a hard money lender is an option to look at, but just know that the interest rates are typically double. And so if you're going to choose a hard money lender, you need to have a really quick turnaround time to be able to refinance it into a traditional mortgage, to be able to get out of that high interest rate situation, okay? The next option is private money, of course, and private money usually comes from people that you may know. So a loan from a family, friend, coworkers, or people that are specifically real estate investors. Private money rates can vary greatly. It depends on the relationship you have with the person, on the property, tons of factors. But in some cases, the money that private lenders may finance to you, they will also include the repairs. So that's another option to think about there as well, if you have that option to be able to tap into. Most people don't, but it is something out there. And there are people that will lend money specifically for real estate if they want to get into investing in real estate, but maybe they're, shy to pull the trigger themselves and you're wanting to take on all the hard work, they may be willing to invest. So just another option to throw out there. Now, when you're rehabbing a BRRRR property, so let's say once you've bought the property, you need to get all of the repairs done. And a lot of beginners like to do the repairs on the properties themselves, but they forget that it equals time equals money, right? So it can take you a lot of time if you have a full-time job and this is something you're trying to do on the side. And it's not easy to fix up a house, especially if you've never had experience. So if you think you're going to save $10,000 by working a few weekends, then you're probably going to be sorely mistaken. In fact, one of the biggest mistakes that people make in their house flipping careers is trying to fix up a house on their own. So that's something to think about, that you want to make sure that you work in the figures of using a contractor, a handyman, or a subcontractor to make the repairs on the home. It's going to save you a lot of money in the end and a lot of time. Because remember, depending on your financing options, from the moment you sign those closing docs, you are paying that interest rate and you're on the hook. So, trying to save $5,000 here, $10,000 there, it may not make a difference in the end, and it may be worth bringing in a professional. Now, when you're renting out a BRRRR property, once the repairs are done, then you need to get the property rented. And a lot of new landlords will try to rent a house themselves just to save money as well. And it's been talked about that it is actually easier to be able to rent the property when you have a property manager, because now you got to remember you're trying to build up a big rental portfolio and you're not going to want to do this with every property. So you may want to think about getting a property manager under contract, and maybe with a clause of their prices or fees go down with every property you have under contract with them, with that contingency that you're going to be adding additional rental properties to your portfolio. So something to think about there. Now, when you go to refinance with the BRRRR strategy, this is super important and really critical to this whole process. The final step to completing the BRRRR process is refinancing the property, if you don't count the repeat, right? And we know the whole point of doing this is to be able to repeat it and go get another property. So we don't really need to talk about that a ton. There are many things to consider when you're refinancing the property and many things that can go wrong, okay? A lot of banks will require a 6-month or a year-long seasoning period to complete the cash-out refinance. So you need to remember that when you're calculating out this whole strategy and the payments that you're making. That means that they're not going to lend you more money on the most recent appraisal or sale of the house, whichever is lower, within their seasoning period. So if the bank has a 1-year-long seasoning period and you bought the house for $100,000 8 months ago, you could get an appraisal for $240,000, and the bank would still base the loan off of the $100,000 purchase price. So make sure that you have a lender, again, when you're going and you're shopping around and you're asking questions, make sure that you have a lender who's going to refinance it to you, before, a year, for example, and ask them what that seasoning period is. Another issue that people run into on multiple occasions is a low appraisal. So when the bank is deciding how much to refinance the home for, they're going to give you an appraisal, and the appraisal will determine what the home is worth in the bank's eyes. So you may think your home is worth $200,000, but the appraisal comes in at $175,000. The bank is going to use the $175,000 value, and typically bank appraisals do come in extremely conservative. So you need to factor that in when you're thinking about the property that you're going to buy and do this process with. That is the difference in a loan amount of $150,000 compared to $131,000. So while you may think that this is unlikely to happen to you, I have seen houses appraise very low when trying to refinance them. And, refinancing a house, for example, I refinanced a house last year and I thought it was going to be worth $260,000. Well, the appraisal came in for my home at $212,000. I mean, what a joke, right? But I could not do anything about it. And we tried challenging the appraisal and the appraiser just wouldn't budge. And they typically will not. It's, going to be a very big surprise if they would ever come back and do another appraisal, because typically appraisers for a bank are a third-party blind appraisal, so they don't even work for the bank. They were just contracted through the bank to do the appraisal. So whatever it comes in for is what they're going to use. So you need to keep that in mind. So if you're going to use the BRRRR method, just make sure that you have a backup plan if you don't get your refinance done right away, or if you're not able to get all the money out that you were hoping for. Because again, those are some hiccups to think about. And that's why I go back to my pro tip from earlier. It's super important to make sure that you have a really good mortgage officer in your pocket that you're working with consistently, and let them know your plan. My plan is to work with you repeatedly for multiple properties, and this is what I want to do, because again, it profits them too. Mortgage officers get paid for every, loan that they close. Even if it's a cash out refi, they're going to get paid on that deal. So they want to work with you. So make sure that you guys are on the same page and tell them what you're looking for, so that way you can try to avoid these hiccups when you're trying to build the portfolio. So let's just say that you do this and you're building up your properties, and now you've got multiple properties. You want to be able to assess the cash flow from these properties. That's the whole point of the BRRRR method, is to have positive cash flow. And I want you to remember too that typically when you're doing this, because you're doing a cash out refi, that's going to make your payment on the property higher. So you're going to need to allow the properties to season or to grow equity on the property prior to expecting to have a positive cash flow from the property. And what that means is additional income from the rents over the mortgage. So for the first little while, usually the rent that you're collecting from your renters is just going to cover the mortgage, because you did that cash out refi. And so typically it's going to just be even with the mortgage. But as time goes on and the properties increase in value, because you identified really good properties from the get-go, then the rents are also going to go up in the area. And that's another thing that you want to make sure that you're looking for when you're identifying properties. And I think we need to do an entire episode on identifying BRRRR properties, because you want to make sure that you're getting a good deal that's under market value, but you also want to look at the rent assessment in the area. So look it up on Zillow. Just type in the zip code or the city that you're looking at, go to that neighborhood and see what rents are going for homes that are similar to the one that you're trying to buy. Because if it's not going to cover the mortgage, or if it's way above the mortgage, it's going to tell you whether it's a good or a bad deal. That's going to be really, really critical. That could be another great reason to have a property manager that you're going to work with from upfront, just like with your mortgage officer, and say, hey, this is what I'm looking at doing. I want to be able to rent the property when I'm done. What would you rent this property for after A, B, and C has been done to the property, whatever you've identified as the repairs? And see what that property manager is going to tell you, because that's what they think that they could market it out to possible tenants, and that's what they think that they could get. So again, enlisting experts is really critical in this process. But this has been a proved process time and time again to be able to be highly successful when looking at building a real estate portfolio, and you don't have tons of cash just to buy these investment properties, just fully outright with cash, and being able to leverage your own assets to build more assets. And over time, the homes will go up in value, and you will have income generating assets that will help you on your road to financial freedom. So I hope this episode helped you guys today. You were able to take away some actionable steps. You can say, hey, I know I need to go talk to a property manager, I need to talk to a mortgage officer, and I need to look at the financing options that are going to work for me, and how can you identify distressed properties. So with that, thank you so much for tuning in. Make sure you're following us on Instagram and TikTok. It's at Financially Free Journey, where I post daily tips and motivation to help you on your financially free journey. Until next time.